If you look at a city skyline, right, the financial district is always, it's just dominated by these towering established
Well,
skyscrapers.
absolutely.
And, in India, those skyscrapers have names like HDFC, SBI, ICICI,
It's a
Axis.
completely monolithic.
Right. They are deeply entrenched in the bedrock of the economy. And if you were to walk into that city today, with a hard hat and a blueprint,
I would look with that.
right. And if you just say, I'm going to build a new skyscraper right here, like right in the middle of them, people would look at you like you were out of your mind.
Because the sheer physical and honestly psychological capital required to get people to move their life savings into a new unproven structure is it's staggering.
Yeah.
It's not just about pouring concrete or setting up a sleek digital interface. I mean, it is about engineering trust from the ground up.
Which is everything.
Exactly, in an industry where trust is literally the only currency that actually matters.
And that brings us to you, the listener, and the puzzle we are going to solve today in this deep dive. Because, imagine trying to build a bank from scratch today.
It's a nightmare scenario for most founders.
Right. How do you convince people to hand over their salary, their retirement funds, their business's working capital when the legacy giants are on literally every street corner?
Yeah, it's a tough pitch.
So, okay, let's unpack this. We have this deep dive into IDFC FIRST Bank. We are tracking a true David operating in a land of Goliaths.
Very much so.
And our core mission here is to understand how a legacy infrastructure lender merged with a retail NBFC, Capital First, and executed this just audacious structural pivot
Yeah.
to become a retail-focused challenger bank in the Indian financial market.
And, to really appreciate the magnitude of this pivot, you have to look at the granular mechanics of liability generation
Wow.
and asset yielding.
Which sounds technical, but it's fascinating.
It is, because we aren't just talking about, like, a rebrand or a new marketing campaign here.
Right.
This is a story about completely unwiring how a balance sheet is funded, how it acquires customers, and how it actually survives in a highly concentrated ecosystem where the incumbents have like a multi-decade head start.
Yeah, a huge head start on cost of funds.
Exactly.
So I want to start by framing exactly what they are selling and to whom. Because looking at their current state, IDFC First is classified as a universal bank.
Right.
They serve retail, SME, rural, and corporate customers. And looking at the sheer breadth of their product suite, it feels a bit like a Swiss Army knife.
It really does.
Because on the liability side, you have savings accounts, current accounts, fixed deposits, NRI deposits.
And then the asset side is just as broad.
Right. It ranges from retail home loans, vehicle loans, unsecured personal loans, all the way to like tractor finance and rural microfinance.
Yeah, they cover a lot of ground.
And then for the SME and corporate side, they're pushing working capital loans, commercial vehicle loans, trade advances, startup banking.
Supply chain financing, yeah.
Exactly. And then you stack fast tags, credit cards, wealth distribution, cash management services on top of all of that.
It's a lot.
It is a lot. So my question is there a risk here that they are trying to be everything to everyone? Like when you're the challenger, shouldn't you just pick one lane, say unsecured personal loans, and just completely dominate it?
You'd think so, right?
Yeah.
Conventional wisdom says focus on a niche. But what's fascinating here is that the mechanics of primary banking in India dictate otherwise.
Really?
Yeah, you actually have to offer the full suite if you want to win the core relationship.
The core relationship.
Right. You cannot just be the personal loan provider and expect to capture the low-cost deposits.
Because they'll just take the loan and keep their main account somewhere else.
Exactly. To make the unit economics work and to drive that cost of funds down, you need the checking account. You need the credit card for transaction velocity.
Okay.
And you need the wealth distribution to capture the affluent surplus. If you only offer a niche lending product, you remain a transactional counterparty.
You're just a vendor, basically.
Yeah. To be a viable primary bank, the one where the salary actually lands on the first of the month.
Right, the holy grail.
Exactly. You have to provide the entire ecosystem so the customer literally never has a reason to leave your balance sheet.
Okay, so you have to build the whole city block, not just one storefront.
Perfectly said.
You can't just be a boutique, you have to be the supermarket. And the scale they have reached across this suite is pretty substantial.
Oh, it's very impressive.
Looking at the FY25 disclosures, their total customer business sits at 4.85 trillion rupees.
Yeah, which is no small feat.
No, and that breaks down to 2.42 trillion in loans and advances and 2.43 trillion in customer deposits.
This is striking symmetry, honestly, and they are executing this through what they call a phygital strategy.
Phygital, yeah, physical and digital.
Right. They aren't a pure digital neobank trying to acquire everyone through, like, targeted social media ads.
Right, they're not just an app.
But they also aren't a legacy brick-and-mortar dinosaur relying solely on foot traffic. I mean, they operate 1,008 branches, but they heavily leverage digital onboarding on the back end.
I want to pause on that phygital concept for a second, because there was a period, like maybe a few years ago, where the prevailing narrative in fintech was that branches were just dead.
Oh, yeah, totally. Branches are dinosaurs was the whole vibe.
Right. The idea was that physical real estate was just this bloated operating expense, and the future was entirely branchless. But IDFC FIRST is aggressively expanding their physical footprint.
Because the physical branch remains the absolute anchor of trust in Indian banking, specifically for gathering deposits.
Gathering deposits, right.
Yeah, I mean, a purely digital player can lend money incredibly easily. People are always happy to download an app to take your money.
Obviously, yeah.
But getting them to deposit their life savings?
That's a whole different ball game.
Exactly. That requires a visual signal of permanence. They need to know there is a physical door they can walk through if, something goes wrong with their account.
Like if a transaction fails or they get locked out.
Right. Now, the digital layer dramatically lowers the marginal cost of onboarding and servicing that customer once they are inside the ecosystem.
Okay.
But you are essentially marrying the physical trust required for liability generation with the digital efficiency required for rapid asset underwriting.
Okay, so they have this universal tool set and they have this phygital distribution model. But to really grasp what they are doing, we need to look at the pie they're trying to eat a slice of.
The total addressable market.
Right, the TAM. So total deposits for all scheduled banks in India sit at an astonishing 200.48 lakh crore rupees.
It's an enormous number.
And that number is compounding at 13.3% year over year.
Yeah, and within that 200.48 lakh crore system, IDFC FIRST Bank holds just 0.85% of overall bank deposits.
Wow.
And on the credit side, as of June 2024, they hold about 1.24% of total bank credit.
See, here's where it gets really interesting to me. You hear 0.85% market share, and normally you think, okay, that's a rounding error.
Right, a drop in the bucket.
A completely insignificant speck. But in a 200.5 lakh crore market, 0.85% is an immense absolute number.
Oh, absolutely.
It means that even a fraction of a percent increase in market share equates to just staggering absolute growth for their balance sheet.
Yes.
Like, they don't need to overthrow HDFC Bank to become a wildly profitable institution, right? They just need to inch from 0.85% to like 1.5%.
Precisely. And we also have to look at the structural drivers that are expanding that pie. The market isn't static.
Right.
You have GST formalization. You have the digital payroll migration, which is bringing millions of previously informal workers into the formal salaried sector.
Getting people onto actual payroll.
Exactly. And of course, you have the explosive, ubiquitous adoption of UPI.
UPI is everywhere.
It really is. And these are structural mechanisms that are pulling cash out from under mattresses, out of informal merchant ledgers, and injecting it directly into the formal banking sector.
Yeah, UPI is such a fascinating piece of this puzzle for me because it essentially traps the money inside the banking system.
That's a great way to put it.
Right. Like when I pay a street vendor for a cup of chai using my phone, the cash doesn't leave the banking system to sit in a physical cash box at the stall.
No, it just moves.
It just moves from my IDFC account to their SBI account or whatever. It remains as a deposit in the formal system, which enhances systemic liquidity.
Exactly. And that means this market is not a zero-sum game.
Right.
India is not a fully penetrated banking market where growth only comes from, like, a bloodbath of stealing a customer from Axis Bank or ICICI.
Right. You don't have to poach everyone.
A vast portion of the growth is coming from the formalization of the economy itself.
So let's look at the MSME credit opportunity as an example of that formalization. Because the gap in MSME credit is estimated at around 25 trillion rupees.
Which is huge.
Yes, small and medium businesses have historically been starved of formal credit. I mean, if you were a textile manufacturer in a Tumtu city 10 years ago, you dealt largely in cash.
Pretty much exclusively.
Right. You didn't have the pristine, audited financials or the traditional property collateral that a legacy bank demanded to underwrite a working capital loan.
No, and this is exactly where the digital formalization creates a totally new underwriting paradigm.
How so?
Well, think about the combination of account aggregators and UPI data trails.
Okay.
We are moving rapidly toward a reality where a business's digital cash flow data completely replaces physical collateral as the primary underwriting tool.
See, that is a wild, almost sci-fi concept if you think about historical
It
banking.
really is.
You don't need to pledge the deed to your warehouse anymore.
Nope.
The bank has real-time API-level access to every single rupee flowing through your GST filings and your UPI QR code.
Yeah, the data itself becomes the collateral.
That's incredible. They can see the velocity of your sales, the seasonality of your revenue, your payment behavior to suppliers, and they can see it all in real time.
And that data trail
Hmm.
drastically lowers the operating cost of underwriting, say, a 5 lakh or 10 lakh loan.
Oh, that makes sense.
Because for a legacy bank doing manual underwriting, the operational cost of assessing a 5 lakh loan wasn't actually that different from assessing a 50 lakh loan.
Right, the paperwork is the same.
Exactly, which is why they ignored the smaller ticket sizes. It just wasn't worth the man-hours.
Yeah.
But IDFC FIRST, utilizing this digital underwriting, can process that data instantly, making the missing middle of the Indian economy highly bankable and, frankly, highly profitable.
Okay, so the market is vast, the drivers are structural, and the data is unlocking entirely new segments of the economy.
Yeah.
But to lend out that $25 trillion to MSMEs, you first have to gather the raw material, right?
You need the deposits.
Exactly, you need the deposits.
Yeah.
Which brings us to what is arguably the most dramatic plot twist in IDFC's history.
Oh, the CASA transformation.
Yes, the CSA transformation.
This is the absolute crux of their structural pivot.
Yeah, CSA current account and savings account deposits is the lifeblood of a retail bank.
It is the cheapest funding source available, period.
Right, and at the time of the IDFC Bank and Capital First merger, the bank's CASA ratio was sitting at a highly dangerous 8.7%.
It's terrifying, honestly.
Let's pause and really let that 8.7% sink in for the listener. If you are running a bank, funding your loan book, when 91.3% of your liabilities are non-CASA, meaning wholesale borrowing, expensive term deposits, short-term institutional money, certificates of deposit.
You were constantly operating on a knife's edge.
Right. You wake up every day sweating about liquidity.
You are entirely at the mercy of the money markets, because wholesale funding is incredibly rate sensitive and prone to sudden flight risk.
Very fickle money.
Extremely. If the macro environment tightens, if inflation spikes and the central bank raises rates, or if there is a sudden liquidity squeeze in the system.
Which happens.
All the time.
Mm.
Wholesale money demands higher yields instantly. Or worse, it just vanishes. They simply refuse to roll over your debt.
Wow.
Granular retail deposits, on the other hand, are the ultimate moat.
Because they're sticky.
They are sticky, they are cheap, and they are generally immune to institutional panic. I mean, 1 million retail customers are not going to simultaneously withdraw their 50,000 rupee savings balances just because the bond yield curve inverted.
Right. It is the difference between like renting a diesel generator to power your house versus taking the time to build your own solar grid.
That's a perfect analogy.
Right. The generator is your wholesale funding. It's loud, the fuel is expensive, the price of that fuel fluctuates wildly every day, and if the supplier cuts you off during a storm, the lights go out immediately.
And that was the reality of an 8.7% tech essay.
Exactly. But building the retail deposit base crossing 1.1 trillion rupees, which at one point made up 77% of their customer deposits, that is the solar grid. It takes years to build, you have to lay the panels branch by branch, street by street, but once it is running, it provides cheap, reliable power forever.
And the economic impact of that solar grid is undeniable in their financial trajectory.
Let's hear the numbers.
Their cost of funds fell dramatically from 7.80% at the time of the merger down to 6.42% by Q1 FY26.
That is a huge drop.
It really is.
Yeah.
And their CASA ratio climbed from that terrifying 8.7% to hover around 50.8% to 51.6% recently.
That is a monumental, almost unprecedented re-engineering of a bank's balance sheet in such a compressed time frame.
It really is rare to see.
But how exactly did they convince people to move their money? Because you don't just put up a billboard and expect someone to go through the immense friction of changing their primary salary account.
No, it's a huge hassle to switch.
Right. Looking at their strategy, brand positioning played a huge role. They leaned heavily into this no hidden charges and simplicity narrative.
They absolutely weaponized customer frustration.
Weaponized frustration, I like that.
Well, customer frustration is a potent acquisition tool if you deploy it correctly. And the Indian banking customer, especially in the retail segment, has historically been subjected to just a labyrinth of fees.
Oh, nickel and dimed to death.
Exactly. Minimum balance penalties, charges for SMS alerts, fees for ATM withdrawals beyond a certain limit, debit card renewal fees.
Right. Imagine you are a salaried employee. Your balance drops below 10,000 rupees for 3 days at the end of the month before payday.
Oh, boom.
Boom, you get hit with a 500 rupee penalty.
Yep.
Then you get charged 15 rupees for the text message telling you about the penalty.
It's infuriating.
It creates deep, simmering resentment. So IDFC first stepped in and said, zero fees, no hidden charges, transparency. And they used that positioning to break the inertia of switching accounts.
But, brand positioning is just the wedge that creates the initial interest. The physical infrastructure is the hammer actually driving it in.
And back to the branches.
Right. Management has been explicit that 80% of their customer deposits originate from retail branches.
80%. I mean, for all the talk of digital banking and app-first ecosystems, 80% of the deposits are coming through the physical doors of a branch.
This is exactly why retail liability generation is the hardest thing to execute in banking.
Because you can't fake it.
No, it is a physical, localized, relationship-based grind. You cannot just launch a slick app and expect local merchants to wire over their entire working capital float.
Right.
You need the branch network to signal permanence. You need the relationship managers hitting the pavement, visiting the local pharmacy, the local distributor, capturing their daily cash deposits and funneling them into a current account.
That perfectly explains the aggressive branch expansion, right? They are laying the solar panels.
Exactly.
But IDFC First isn't the only one building branches. I mean, every single bank in India knows retail deposits are cheap fuel.
Oh, they all want CASA.
So how are they surviving in the ring with the undisputed heavyweights? Let's look at the competitive landscape. As we established, it is top-heavy. HDFC Bank, SBI, ICICI Bank, Axis Bank.
The giants.
They absolutely dominate deposits and prime lending. And at the bottom, the market is highly fragmented with NBFCs, small finance banks, and fintechs.
So IDFC First is squarely in the challenger bank category.
Right.
And the competitive position varies wildly depending on the specific asset class.
Okay, break that down.
Well, in home loans, they're a very small challenger. In vehicle loans, they're a niche competitor. But in SME and unsecured personal loans, they are a highly competitive, aggressive force.
It feels completely counterintuitive that they are crushing it in SME and unsecured loans, but are barely a blip in home loans.
It does seem weird at first.
I would assume home loans are the safest bet for a new bank, right? The loan is secured by an actual house. Why wouldn't they lead with mortgages?
You'd think so. But here is where the rate sensitivity of mortgages changes the game entirely.
Ah, rate sensitivity.
Right. In home loans, the big four incumbents have an absolute iron grip. A home loan is a 15 or 20-year commitment, and the customer is hypersensitive to the interest rate.
Because even a fraction of a percent over 20 years is a lot of money.
Exactly. And because the legacy banks have multi-decade pools of cheap CASA, they have the absolute lowest cost of funds.
So they can underprice everyone.
They can offer a mortgage at a rate that would compress IDFC's margins to zero. IDFC simply cannot win a price war on mortgages against someone like SBI.
Okay, that makes sense.
But in unsecured personal loans in SME lending, the dynamics shift completely. Approval speed, seamless digital journeys, and rapid underwriting matter just as much, if not more, than a basis point of interest.
Right. If I am a distributor and I need working capital for my warehouse this week to fulfill a sudden surge in orders, I am not going to wait 4 weeks for a legacy bank to process physical paperwork.
No, you can't afford to.
I'm not going to sit around while they demand property deeds and scrutinize 3 years of tax returns just to save 0.2% on the interest rate.
Exactly.
I will gladly pay a slightly higher rate if IDFC's tech stack allows them to underwrite me digitally and disperse the funds in 48 hours. They win on turnaround time.
If we connect this to the bigger picture, the large incumbents are naturally gravitationally pulled toward the largest, most prime ticket sizes.
Because it moves the needle for them.
Right. They focus on top-tier corporates and prime urban retail, where they can deploy vast amounts of capital efficiently.
And IDFC?
IDFC is finding its alpha in that missing middle. The granular MSMEs, the self-employed professionals, the emerging affluent, these are segments where relationship banking combined with rapid digital approvals wins the deal,
Right.
and where the ticket sizes might be too operationally intensive for the largest banks to prioritize with the same agility.
What about the fintechs? Because we see lending apps proliferating everywhere.
Of it everywhere.
Every week, there is a new startup offering instant credit. Are they an existential threat to a mid-sized challenger like IDFC?
Not really. The fintech ecosystem acts much more as a distribution layer than a direct competitor.
A distribution layer, okay.
Yeah, fintechs lower the customer acquisition barriers through incredible UI and targeted marketing, but they typically don't hold the balance sheet.
They don't have the actual money.
Exactly. They don't have the banking license or the deposit base to fund the loans they originate. They need a regulated entity's capital behind them.
Right.
Now, IDFC FIRST is very strategic here. They partner with these digital trends, embedding their balance sheet into these distribution networks via like co-branded credit cards or API lending, rather than fighting a pure direct-to-consumer war against agile tech companies.
So customer bargaining power is incredibly high because switching costs are low on the asset side, and you download a new loan app in seconds.
Yep.
IDFC wins by offering a superior digital experience compared to the legacy players and by partnering smartly with the fintechs.
Exactly.
But acquiring customers and originating loans is only half the battle, right? Translating that activity into actual sustained profits is a completely different game.
A much harder game.
Let's follow the money and look at their profitability and spreads.
This is where we analyze the economic engine under the hood. The net interest margin, or IM, is the ultimate metric here.
Okay.
IDFC FIRST's NIM is structurally high, hovering around 5.75% to 5.96% in recent disclosures.
And for context for you listening, a NIM approaching 6% is exceptionally strong in the banking sector.
It's very, very high.
It shows they are successfully executing on both sides of the balance sheet. Borrowing low, thanks to that 50.8% CASA ratio, and 6.42% cost of funds, and lending high.
Right. And the core profit pools driving that yield are retail and what they categorize as RAM,
RAM.
retail, agri, and MSME lending.
Ram bought it.
Management notes that these specific segments are capable of generating high teens ROE at scale.
Yeah.
We see this flowing through to the absolute bottom line.
Yeah, I have the numbers here. FY25 profit after tax came in at 1,525 crore rupees.
A solid number.
And just Q1 of FY27 hit 1,075 crore rupees.
And they're also stacking fee income on top of that spread.
Right, the cross-selling.
Exactly. Credit
Yeah.
cards, fast tags, which is just a brilliant ecosystem play for toll payments, by the way. Cash management services for corporates, and wealth distribution. It is the textbook definition of universal banking, capturing every sliver of value from the customer's transaction velocity.
But there is a nuance here regarding their corporate lending book, isn't there? They aren't relying on wholesale, large corporate banking for high yields.
No, the wholesale and corporate lending side is utilized primarily for balance sheet efficiency and scale.
Not profit maximization.
Right. The yields on corporate loans are significantly lower because large corporations have immense bargaining power.
Sure.
But the operational costs and the credit risks are also lower. It provides stability and asset scale, while the granular retail and MSME books provide the high-margin spread that actually drives the profitability.
But those high margins are being aggressively, relentlessly reinvested.
Oh, heavily.
We have to talk about the operating leverage, or more accurately, the current lack thereof in certain growth segments.
Yeah, that's a big point.
Because they are targeting a footprint of 1,700 to 1,800 branches by 2029. That is essentially doubling their physical network.
It's a massive capital outlay.
And businesses like credit cards are explicitly noted as still being in the investment phase, meaning they haven't fully broken even yet.
This is the classic J-curve of building a banking franchise.
The J-curve, right.
You incur the fixed costs of real estate, interior fit-outs, technology stacks, and personnel upfront.
Before you make a dime.
Exactly. You are paying rent on a branch and salaries to the managers long before that specific branch has gathered enough deposits or originated enough loans to cover its own operating expenses.
So what does this all mean? It means they are currently running on a treadmill.
Sweating profusely.
Yes. They are sweating to build all this infrastructure, opening branches, acquiring credit card customers by the thousands, and they are trusting that the revenues will eventually outpace the costs of setting up all these systems.
They're waiting for that operating leverage to really kick in.
Right. They are betting heavily on it. They are borrowing at roughly 6.4%, lending to SMEs at maybe 14%, and using that immense spread not to pay fat dividends, but to physically fund the concrete, glass, and servers of the new branches.
And that is the bull case for the stock. But that 5.75% to 5.96% IM is a tightrope walk.
Because high margins mean high risk.
Exactly. High margins in banking rarely, if ever, exist without a corresponding level of risk. If you are earning higher yields, it generally implies you are lending to riskier, unsecured, or undercollateralized segments.
Which brings us to the most vital question for any financial institution: credit costs.
Yes,
A bank's profit is just a hallucination until the loans are actually paid back.
so true.
If we dig into the balance sheet, what are the stress fractures? What are the red flags we need to look at here? Because unsecured lending plus a high NIM usually equals high risk.
Well, on the surface, the asset quality looks commendable.
Okay.
The gross non-performing assets, or GNPA, has generally been contained below 2%, with recent figures around 1.61%.
That's pretty good.
And the net NPA is remarkably low, around 0.48%. By historical Indian banking standards, those are very clean numbers.
And I'm looking at a specific pocket of pain here: the microfinance, or MFI, portfolio.
Yes, the MFI stress.
Elevated slippages in the microfinance segment were explicitly called out as a major drag on FY25 and Q1 FY26 profitability.
And this is the inherent vulnerability of the RAM and unsecured retail strategy.
Right.
When the macroeconomic environment tightens, when inflation bites the rural economy, or when there are localized disruptions.
Like erratic monsoons or supply shock.
Exactly. Microfinance and unsecured retail borrowers are the very first to show stress. They do not have the balance sheet buffers that a large corporate does. They are managing their cash flows day to day, week to week.
So if I'm hearing this right, the very things driving their impressively high NIMA, the unsecured personal loans, the SME working capital, the microfinances, are also the exact things most likely to blow up in their faces during a severe economic downturn.
It is the defining tension of their business model. I mean, maintaining a GNPA below 2% shows they have managed it well during periods of relative economic stability. But in unsecured lending, the metric to watch obsessively isn't just the absolute default rate, it is bucket migration.
Bucket migration, what does that look like in practice?
It is tracking when a borrower goes from being 30 days past due on a payment to 60 days past due and eventually 90 days.
Migrating down the bucket.
Exactly.
Yeah.
That migration rate is the ultimate canary in the coal mine.
Okay.
If that pace accelerates, if you see a sudden spike in the 30-day bucket migrating to the 60-day bucket, the high NIM gets completely wiped out by the provisioning required for those souring loans.
The profits just vanish.
Overnight. Because you have to set aside capital to cover the anticipated losses.
It's like driving a sports car.
Okay, I like that.
The high NM is the horsepower. It feels great on a straightaway. But if the brakes, the underwriting discipline, and the collections infrastructure, if they fail when you hit a sharp turn in the macroeconomy, you crash much harder than a legacy bank driving a slow, steady corporate loan book.
A very apt analogy.
And speaking of controls failing, we absolutely have to address the 590 crore rupee fraud.
Yes, we do.
Because that's a big number.
The reports detail an isolated incident involving government-linked accounts, noting the capital impact was capped at about 1% of the bank's net worth.
1% of net worth might sound small to a casual observer scanning a headline, but a 590 crore fraud is a severe governance failure.
It is.
We can't just gloss over that. It directly highlights the operational risks of their rapid J-curve branch expansion.
Absolutely.
Because when you are opening hundreds of branches and scaling this aggressively, ensuring that every single branch manager, every relationship manager, and every teller is adhering to pristine compliance protocols is incredibly difficult.
It really is. A control failure of that magnitude, particularly involving sensitive government accounts, is a severe stress test of governance.
Right.
It invites intense regulatory scrutiny and demands immediate systemic remediation of branch-level monitoring and internal audit systems.
It's a wake-up call.
It proves that growth cannot outpace the control environment.
And regulatory risk is ever present here. The RBI, the central bank, is constantly monitoring unsecured lending and digital KYC norms.
Oh, they watch it like a hawk.
If the RBI looks at the systemic data, decides the unsecured lending space is overheating, and unilaterally tightens the capital requirements on those specific loans.
Which they have done before.
Exactly. IDFC's primary growth engine could face immediate severe friction.
Alongside asset quality and regulation, we must look at their liquidity position. The loan-to-deposit ratio, the LDR, sits at a high 93%.
Let's break that down because this is crucial to understanding the pressure they are under.
Yeah, 93% is tight.
A 93% LDR means that for every 100 rupees of deposits they take in from customers, they're lending out 93 rupees.
Leaving almost nothing in reserve.
Right, that leaves very little buffer. It means the bank must keep deposit growth exceptionally high every single quarter just to feed the loan machine. If their deposit gathering slows down, say if people stop opening savings accounts, or if a competitor starts offering better rates, they face a liquidity crunch.
You'd hit a wall.
They would have to instantly throttle their loan growth, which kills their momentum and impacts profitability.
It creates a treadmill effect not just on their operating costs, but on their funding structure.
Right.
They're locked into a cycle where they must aggressively win retail deposits constantly to fund the high-yielding asset engine they have built. They cannot take their foot off the gas on deposit acquisition.
So managing a 93% LDR, scaling to 1,700 branches, navigating microfinance slippages, dealing with the fallout of a governance failure, and maintaining a 50% SSA ratio against intense competition.
That's a lot of plates to spin.
Doing all of this simultaneously requires a very specific, aggressive type of leadership and risk appetite. Which brings us to the individual steering the ship and the broader market narrative.
The architect of this entire transformation is the CEO, V. Vaidyanathan, who led the merger of his retail NBFC, Capital First, with the legacy IDFC Bank.
One of the most fascinating details in the structure of the bank today is the ownership. The promoter holding has effectively dropped to 0% at the operating bank level.
Right.
If you look back to FY19, it was around 40%. Now it is fully institutionalized, and the board is heavily independent.
The implications of a 0% promoter holding are profound.
How so?
In the context of Indian business, a dominant promoter, like a founding family or a single massive shareholder, can be a double-edged sword.
Okay.
On one hand, they provide long-term vision, stability, and the ability to weather short-term market pressure.
Because they aren't going anywhere.
Right. On the other hand, there's the persistent risk of entrenchment, lack of independent oversight, or capital allocation decisions that favor the promoter's other business interests over minority shareholders.
Okay, so moving to a 0% promoter holding completely removes that entrenchment risk. It is a clean, professionally managed structure. But it also drastically shifts the dynamic of accountability, doesn't it? Without a single dominant owner holding 40% of the equity, who exactly is holding management's feet to the fire if they miss their aggressive targets or if credit costs spiral?
That responsibility falls entirely on the independent board of directors and the institutional shareholder.
It's all on them.
It demands a phenomenally high level of transparency and performance.
Yeah.
And we see that tension playing out vividly in how management allocates capital.
Right, they reinvest everything.
They have been intensely focused on reinvestment into the franchise rather than returning capital to shareholders via dividends or buybacks.
They have continually diluted equity to fund this relentless growth. They raise capital, deploy it into opening branches and building tech stacks, grow the loan book, and then raise capital again.
It's a cycle.
Minority shareholders have essentially been funding a sprawling, multi-year construction project, waiting patiently for the grand opening, where the true high teens ROE profits finally start rolling in consistently, without the bank needing to tap the equity markets for another capital raise.
Which perfectly frames the current bull versus bear debate playing out in the market regarding their stock.
Let's hear it.
The bulls look at the 50% CASA ratio, the impressive 5.75% IM, and the contained GNPA, and they believe the margin and return inflection point is right here, right now.
They think the wait is over.
They argue that the hardest heavy lifting, building the retail liability franchise from scratch, is fundamentally done, and the operating scale will now drive the promised returns.
But the bears look at the exact same data and see a different, more cautious story.
Oh, very much so.
They worry about the intense deposit cost pressure. Remember that 93% LDR means they have to keep paying competitive rates to attract deposits, which could compress the enemy.
Margins could shrink.
Right. The bears point to the microfinance stress and the 590 crore fraud as early warning signs that the rapid growth is causing structural fatigue in the underwriting and control systems.
They see a long, indefinite wait for those pristine high returns. Both perspectives are entirely rational based on the data available.
Yeah.
Management has unequivocally proven they can build a retail liability franchise from the ashes of a wholesale infrastructure book.
Which is incredibly hard.
It is arguably the hardest thing to achieve in all of banking.
They successfully built the solar grid while the engine was still running.
They built it.
Mm.
But the final hurdle is proving they can squeeze consistent, top-tier economic returns out of that grid across a full economic cycle, not just in periods of aggressive credit expansion.
Right.
They have to prove the operating leverage is real, that the 1,700 branches will essentially fund themselves, and that credit costs won't devour the margins when the macro environment inevitably turns hostile.
Bringing this all together, we have mapped the anatomy of IDFC FIRST Bank.
It's been quite a journey.
They transformed from a vulnerable, wholesale-dependent lender constantly worried about liquidity into a universal retail challenger. They achieved a remarkable feat in pushing their CASA ratio from a terrifying 8.7% to over 50%.
Incredible numbers.
They weaponized customer frustration regarding hitting fees to gather cheap deposits. But they are walking a highly profitable yet delicate tightrope with unsecured lending, microfinance exposure, and a 93% LDR, all while racing to double their physical branch network.
It's a masterclass in structural balance sheet pivoting, but the execution risk remains exceptionally high.
So for you, the listener, why does this matter? Even if you never open an account with them or look at their stock ticker again, if you're watching the broader Indian economic growth story, IDFC FIRST Bank is one of the most fascinating pure proxies for the formalization of Indian savings and credit.
Absolutely.
They are riding the giant waves of GST formalization, UPI data trails, and the shift from informal cash lending to formal, data-driven finance.
Their ultimate success or failure will be a direct indicator of whether mid-sized challenger banks can sustainably break the oligopoly of the top 4 legacy institutions through superior technology, targeted retail focus, and rapid underwriting.
Before we wrap up, we've talked extensively today about their rapid digital onboarding, their tech stack, and their immense push to build physical branches.
Yeah.
But here is something for you to ponder long after this deep dive ends. We are entering an era where artificial intelligence is going to completely commoditize digital interfaces.
That is a very real trend.
Right. In 3 years, every single banking app, whether it's SBI, HDFC, or a new fintech, might look, feel, and anticipate your needs the exact same way.
The AI will smooth all the differences out.
The UI will be flawless across the board. So when the digital experience becomes completely uniform across the entire industry, will the physical trust generated by those 1,700 brick-and-mortar branches become the only true differentiator left in consumer banking?
That is a fascinating thought.
When the tech is entirely equal, maybe the winner is simply the bank whose physical branch you walk past on your way to work, reminding you that your money actually exists somewhere in the real world.
A physical anchor in a digital storm.
Exactly. Building a skyscraper in a crowded financial district isn't just about having the most advanced blueprints. It's about pouring concrete that people can actually see, touch, and trust. Thank you for joining us on this deep dive. Until next time.